Good morning, everyone. Thank you for tuning in. It is February 2nd, and we here at Harvested Financial are looking at the markets. What do we have for you today? Well, we have a collar in SLV. So silver's up 13% in the last 5 days. What are we going to do? How can we lock in some gains? Well, a lot of things going on there. So before we get to that, I'm going to give you a quick rundown of what's the markets are looking at this morning. We had a big rally yesterday. S&P was up over 60 points, and now we continue to go up. So SPY's up another $4.50. That's about 45 points on the S&P. We got IWM up $1.60 or 76 basis points, and we have the Qs up $4.22 or $1.29. So real rally after Friday's sell-off. So as the markets continue to churn, we are looking at opportunities, and we are continuing to talk about some of these names that have been squeezed or attempted to squeeze. And so while we talked a lot about GameStop, I encourage you to check out our Options Brew episode with Lex yesterday. Hit the subscribe button. You will definitely find some great content there talking about short squeezes and gamma squeezes. But one of the other names that is out there is SLV. So for those that aren't totally familiar, SLV is the silver ETF. And the way they are trying to squeeze the silver ETF is that there is a thesis out there that there is not enough silver out there to match the demand. So it's actually, silver has been on a run for much longer than just this most recent squeeze. So we think it's a really interesting opportunity where you might want to consider a collar type strategy. So I'm going to go ahead and share my screen with y'all. And first off, I will pull up that chart of silver. So, we are looking at some pretty significant gains. Like the card said, we're up 13% just in the last couple days. So big jump off here. And, we're also seeing it trend relatively close to some of these recent highs. So, it got as high as 27 in August, off some of those lows of down around 11 in late March. But with silver all the way up here, what can we think about in terms of a collar strategy? It's a great way to lock in gains. So collar strategies, if you'll recall, are where we sell a call and where we buy a put, and this locks in the actual value of our equities. So the idea here is, and I will just come right over here, is to look for something going out. So, I'm going to go out about 45 days. I'm looking at the March expiration here. And to lock something in right around where the stock's value is trading right now. So, or the ETF, underlying ETF. So with silver trading around 25 right now, I might go to put a relatively tight collar. So a tight collar would mean that you don't necessarily want to profit if the stock goes up, and you want a lot of downside protection. You can go with a much wider collar if you're willing to let a little bit run. But very tight collar going out to that main serial March expiration. Buying the 24 half put will cost us about $1.30. So nice tight markets in here, actually, only a penny wide. So we love to see that. We love seeing real tight markets that retail traders can get in and act upon. So if I buy that downside put for $1.30, I need to finance that. So I'm going to finance that by selling a call. And look at the skew here. So we're actually buying 46 vol on the 26 line. So, that's that 46 number right under there. And because of the upside skew, that means that I can sell the 26 half call. So compared to where silver is right now, I have about 60 cents of downside, maybe 70 cents of downside. We're trading around 25.20 down to 24 half. I have 70 cents of downside. But I get almost $1 of upside, going all the way, more than $1 of upside, like $1.30 of upside all the way up to 26 half, because that's trading around a 51 vol. So sort of an interesting quirk there, that there definitely seems to be some demand for some of those upside calls, which makes it a great place that you can sell that upside call to protect yourself on the downside. Now you're certainly giving up that upside, so always a balance here between some of that risk reward. But for around 3 cents, you can have a really nice kind of skewed distribution here, where you're protected, of a move of more than 70 cents to the downside, but you get an extra $1.30 up on the upside. So with silver trading up where it is, maybe you've been a long time holder, maybe you just have some recent gains that you want to kind of put a pause on. Putting a zero cost collar is an incredibly effective way to manage your position. To the extent that we see silver go down, it might even be an opportunity that you can use some of the funds from that put to purchase more shares. So even if you're a long-term bull, a collar presents a great opportunity to set yourself up for some future dollar cost averaging opportunities. So you think we might be a little bit elevated now and concerned about a potential pullback? Well, using that put proceeds when that pullback does happen allows you to buy dollar cost average at a lower rate to keep that long-term bullish thesis going. So zero cost collars, incredibly effective way to manage stock positions, whether it's something that's run up in gains like this, whether they're RSUs, employee stock, whether it's inherited stock that you've been sitting on. A collar is an incredibly effective cheap option strategy that delivers an insane amount of power to your portfolio. So make sure to check us out every day here on the Daily Bread, 8:35 Central, 9:35 Eastern. Mash the subscribe button. You will get this to your inbox. Sign up on our website at harvestedfinancial/dailybread. And you can have this along with so much more information delivered to your inbox. Make sure to follow us along on Twitter also at harvested_DAFE because derivatives are for everyone. Thanks again for tuning in. We'll be here systematically executing option strategies and making investors' portfolios as robust and amplified as possible. Thanks again, everyone.